Today we will be discussing analysis of business transactions. And what are business transactions? They are business economic events that must be recorded by accountants, and they could be external or internal. And as we will discuss in the next slide, not all the activities will represent a transaction. They will have dual effect on the accounting equation, and you will see. So currently, we're starting with you what's called the accounting cycle. So we're at the very first step of this analysis of business transaction. Let's take a look. How do we analyze it? So here's an illustration. Is the following event recorded or not? Purchase of the computer, for example. The first question that you would ask yourself: is the financial position, meaning assets, liabilities, or owner's equity of the company, changed? And if the answer is yes, like it is in this case, because we've got more computers and it's an asset, so we do have a change, that means we need to record it. Discuss potential product design with the customer. In this case, neither assets, liabilities, or equity has changed yet. Therefore, we do not need to record something like that. And the last example here, pay rent. In this case, we paid rent, probably in cash. So since cash changed and it's an asset, we will record this event since financial position of a company changed. Let's take a look at the following transactions. And I explain them slightly different than what the explanation in the textbook is. So please pay careful attention. Sam Doty opened his law practice during the month of September and provided you with the following data. So for the first one, Sam invested $8,000 in his business. So even though Sam lost or gave up $8,000 worth of cash out of his personal pocket, remember, we have to separate his personal pocket from the business pocket. And as a result, for business, we're doing the books for the business. Cash, which is an asset, went up, and then capital or investment by the owner. And I'm going to put C for capital. So identify exactly what it is, what the criteria went up as well. Think of it as his share in the business become larger. How about next one? The business purchased $5,000 worth of supplies on account. So watch out for that word. If we purchase supplies, supplies are an asset. That's your future economic benefit that you can use. Those went up. And then because it was purchased on account, it tells you we have not spent any cash. If you see it as worded, purchase $5,000 of supplies, period, assume you paid cash. If they added on account, that means we have not paid cash yet. So we will use accounts payable. And if you remember from prior discussion, payable is a liability. So we're more liable now, and it went up as well. Next one, compare 2 and 3. So we purchased supplies on account versus we purchased equipment on account. So both are on account. Guess what? Accounts payable stayed. It's a liability and went up. What's different? We used supplies before. Now we need to use equipment as an asset. How about next one? Received $3,000 for services provided. If we received $3,000 and they did not explain anything else, we received it in form of equipment or they gave us land, assume it must be cash. So cash is an asset, went up. And in this case, services provided. If you remember, when we provide services or sell goods, that's a gross increase in owner's equity. So as a result, your service revenue, and I'm going to put R for revenue as opposed to just owner's equity, I want to be as specific as possible, went up as well. This is slightly different, this approach is slightly different from the book, but I find it easier for the students then to convert what we're doing into debits and credits in chapter 2, so please stick with me. Next one, paid office rents for September. So the month of September must have already passed, and we just spent, oh, I skipped one, sorry. Paid salaries, $800. So if we paid, our cash as an asset went down, and our expenses, and I'm very specific, I'm going to put it as a salary expense, actually went up. Sometimes students get confused and they say, wait a minute, but I paid that expense off. Yeah, you did pay it, but since you consumed somebody's services, in this case, your employee's services, that's your expense. So expenses just went up. And yes, you paid them, you're not liable anymore, that's good news, but expenses are still up. The same thing again, paid office rent for September. If you compare those two, they're very much alike. How? You spend your assets, your cash, and you just had an increase in another type of expense, rent expense as well. And then next one, you paid $1,000 that you owed to creditors. If you go to transactions 2 and 3, we bought supplies on account and equipment on account. So now this account payable that we owe to creditors, that's your liability, is being paid off, so it just went down. And what else? Cash, your asset, also went down. Now, in these examples, we're constantly using cash. Not always will you have cash, and not always will it have to be listed first. For now, when we're doing increases and decreases, the order doesn't matter. It will matter once we switch to debits and credits in Chapter 2. Sam withdrew $1,500 from business. So business just lost $1,500 worth of cash. Where did it go? Into Sam's personal pockets. So drawings, that's part of equity. I'm going to put D for drawings. And again, it's part of equity. Went up, meaning his drawings are higher than what they were before. And this is pretty much it. This is how you do the analysis of transactions.